Hello and welcome back to Josh Delosier Investments. Today we're talking about the basics of investing, stocks, bonds, mutual funds, and types of interest. Let's get right into the video and we'll start off with talking about stocks. When you buy stock, you purchase a share in the ownership of a publicly traded company. This ownership comes with rights such as voting on key company issues, receiving dividends, and benefiting financially if the company's value appreciates over time. Generally, stocks have a few ways to appreciate value. One is capital appreciation. When a stock's price rises above your purchase price, you sell. The difference is your capital gain. This is one of the primary sources of wealth building through stocks. Second, dividends. Some companies distribute a portion of their profits to shareholders, such as if you own Altria Group or Main Street Capital, O Realty are all great examples. Dividends are usually paid in cash sometimes are issued in additional shares. It just depends on how you set up. Also, Webull, for example, it pays a cash dividend if you use that brokerage. However, if you use other brokerages, you can use the DRIP method and just continue to get a fractional share back of that company. It just really depends on whichever you prefer to do. But most stocks pay a dividend every 3 months. Some such as Main Street Capital and O Realty pay it every single month. So it's really whatever your preference is there. Then we can take a quick look at other key things we would look at today are, we're going to take a quick look at bonds real quick. As well as mutual funds and different types of interest. Bonds are considered, a more conservative way to make profits, but it's generally, bond investing is it's something we don't talk about a whole lot, but we're going to make another video on bonds here in the near future. Bond is a fixed income asset, a fixed income investment where an investor loans money to a government, corporation, or other entity. In return, the issuer promises to pay periodic interest, known as a coupon rate, and to repay the principal, which is the face value, at a specified maturity date. Look at how bonds work. The entity it's borrowing funds from a government, corporation, or municipality. The investor or the lender who receives regular interest payments. Also the coupon rate, which is the fixed or variable interest paid to the bondholder. Maturity, the date when the borrowed amount, the principal, is repaid. And then we look at the face value, the amount the issuer agrees to repay at maturity. We look at the major types of bonds. There's government bonds, corporate bonds, agency bonds, municipal bonds, emerging market, high yield, also known as junk bonds, and zero coupon bonds. You always have to look at the yield and return, or basically we look at the yield to maturity, the total return if held to maturity, factoring current price, coupon, and time left. We also look at the annual interest divided by the current market price for the current yield. And then the price yield inverse relationship. As market interest rates rise, bond prices fall, and vice versa. The relationship is fundamental to bond investing. Also, you got to take a look at the duration. That measures a bond's sensitivity to interest rate changes. A higher duration means greater price volatility when rates fluctuate. For example, a bond with a duration of 5 years will change about 5% in price for every 1% change in interest rates. A few benefits to bond investing: there's steady income, capital preservation, diversification, tax advantages, and lower volatility. If you choose to diversify your portfolio, people who are more conservative tend to favor bonds over stocks. Also, as people age, a lot of more conservative investors tend to add more bonds to their overall portfolio just to get fixed income. Everyone has different risk tolerances and different financial situations. So always be sure to do your own due diligence and see what's best for you. Next, we're going to talk about mutual funds. I personally owned mutual funds back when, I was just starting out. That was my first investment, as I owned stocks and mutual funds. I think it was the PIMCO mutual fund in New York. That was over 25 years ago. But, personally, I would recommend owning stocks and just because of the potential ROI on stocks. If you own companies with moats such as Tesla, Nvidia, Eli Lilly, you can make a you look at Nvidia's up 3,000% the past 5 years. Eli Lilly had an amazing run. Tesla, all doing exceptional well compared to mutual funds. It's a little bit more complicated. Mutual fund is an investment vehicle that pulls money from multiple investors to purchase a diversified portfolio of assets, such as stocks, bonds, other securities, managed by professional fund managers. Mutual funds allow individual investors to access to a broad range of markets. A lot of times you can buy international funds if you really want to diversify, broadly. So you really could own a little bit of everything, but overall you're not going to see the same type of gains as you would with stocks if you stick to the best companies in the world. So, and of course you've got to also watch out for the fees that come with mutual funds. So, but mutual funds are there for people who are just have their heart set on it, you know, they are still available to invest in. Next, we're going to talk about types of interest. You know, basically, you don't want your money sitting somewhere and not working for you. If your money's sitting in a bank or something, someone else is basically using your money to make profits for themselves. So your money's not just going to sit somewhere and do nothing. You know, someone somewhere is either loaning it out, you know, like a bank is using it to make their own profits. So always have your money working for you, because your money can make a lot more money than you can actually working. Take a quick look at a few different types of interest. There's simple interest. Simple interest is calculated only on the original principal amount, never on any accumulated interest. Second is compound interest. Compound interest is calculated on both the principal and the previously accrued interest, leading to interest on interest. And that is where we see exponential growth over time, just by letting things compounding. You know, the compound effect is the eighth wonder of the world. So you definitely want it working for you. Big companies such as Visa and other credit cards actually use this as their business model. Anytime you're using a credit card and you're in debt, you're basically having the compound effect working against you. So you always want to keep your bills paid, have no debt. You know, if you're using a credit card, be sure to use it to be building your credit. You know, that would be really the only advantage. Owning a credit card really is to build your credit and to get back the 2 to 5% savings. But the main thing is, don't let the compound effect work against you. Always have it working, you know, for you. Third, we're talking about accrued interest. Accrued interest is interest that accumulates between payment periods but has not yet been paid. Next, we're going to go over fixed versus variable interest. Fixed interest rate remains unchanged throughout the loan or deposit term. There's predictable payments, shields against rate hikes. Then there's variable interest rates. You know, they can fluctuate based on an underlying benchmark. Also offers lower starting rates, but exposes borrower to future increases. You know, it's always important to read the fine print and make sure you understand, you know, what the actual deal is in any contract. And there's a few other specialized types, such as nominal interest rate, real interest rate, effective interest rate, annual percentage rate, discounted interest rate, prime interest rate. You know, borrowers generally prefer simple and fixed interest for predictability and lower cost, especially over short periods. So, you know, the main thing is always understand these terms and make sure to get the best deal possible. Really appreciate everyone watching this week's video. So, you know, please hit the like and follow. We're trying to get this account monetized. If there's anything in personal finance related, or, you know, investing that you'd like me to cover in a video, please leave in the comments below. I'll be more than happy to include it in my next video. Should have another video up this week on stocks that are it's a great time to buy, such as Tesla. It's actually trading at $303 a share. Just dropped after earnings. We'll do a video on that probably later this week. Appreciate everyone watching, and have an amazing weekend.